Welcome to this explainer. If you've ever stared at a spreadsheet full of numbers and wondered how they actually connect to the success or failure of a business, well, you are definitely in the right place. Today, we're going to transform the dry mechanics of accounting into a compelling, totally logical narrative about your business's financial health. So here's our roadmap for today's financial funnel. 1. Decoding the trial balance. 2. Closing off ledger accounts. 3. The income statement. And 4. The balance sheet snapshot. Let's dive right in.
All right, section 1, decoding the trial balance, which is step 1 of the funnel.
Okay, so for every debit, there is a corresponding and equal credit. That right there is the golden rule of the double entry accounting system. It's a system actually popularized by a Renaissance monk named Luca Pacioli way back in 1494. The trial balance is really just an internal tool we use to make absolutely sure our records perfectly obey this centuries-old rule. We've got to verify our arithmetic before we even think about building any external statements. To extract these balances, there's a really straightforward 5-step process to pull everything together into one summarized list. First, you just list out all your general ledger accounts, stuff like cash, inventory, loans. Second, determine their normal balances. Third, transfer those balances over to the debit or credit columns. Fourth, calculate your totals. And fifth, the moment of truth, ensuring those totals perfectly match.
Now, when we plug in some sample numbers, you can really see the magic happen. Look at how those 15,000 rupee totals align perfectly at the very bottom. On the left side, we've got debits like cash and rent expense. On the right, credits like accounts payable and sales. Because both sides equal exactly 15,000, it proves our ledger is mathematically sound and we haven't missed a single entry.
Moving on to section 2, closing off ledger accounts, basically resetting for the next lap. So, with our math verified, we had a bit of a narrative pivot here, closing accounts to reset for the next period. Think of temporary accounts like your income and expenses kind of like a stopwatch. That stopwatch absolutely must be reset to 0 at the end of every period so you can accurately time the next lap. Permanent accounts, on the other hand, your assets, liabilities, and equity, those are like a marathon runner. They don't reset. They just keep carrying your running balance forward. Right, so how exactly do we reset that stopwatch? We follow a quick 4-step procedure. Step A, close revenues to 0. Step B, close expenses. Step C, close the income summary to capture the net effect. And step D, close out any dividends. The ultimate goal here is to funnel all of that temporary performance data directly into your permanent equity. This is exactly what allows you as a business owner to start totally fresh on Monday morning while keeping your historical wealth intact. Now, the crucial anchor for all of this is the fundamental accounting equation. Assets equals liabilities plus equity. This must always hold true. If you ever forget to carry over your newly calculated profit into your equity account after closing those temporary accounts, well, your numbers will flat out fail to balance. It's literally a built-in alarm system ensuring that no value just vanishes into thin air. All right, section 3, the income statement, measuring performance. Now that our data's clean and our stopwatches are reset, we can build the income statement. This answers the most burning question of all. Did the business actually make money? You can think of this statement like a motion picture. It captures your financial performance, every single dollar earned and spent, playing out continuously over a specific period of time. By funneling our trial balance data into strictly revenues and expenses, we create a really clear, readable summary. We can easily stack our 30,000 rupees in total revenue from sales and services directly against our 13,000 rupees in total expenses, like rent and salaries. And the results of that simple subtraction, it gives us a triumphant net profit of 17,000 rupees. This single number represents the real climax of our income statement story. It tells us exactly how much value the business generated during this period. Which brings us to section 4, the balance sheet snapshot, your financial picture. We know how much money we made over time, sure, but we also need to know where the business stands right now. This brings us to the ultimate output, the balance sheet. If the income statement was our motion picture, well, the balance sheet is a photograph. It completely freezes your exact financial position, what you own, what you owe, and what's left over at a single specific moment in time. By taking our remaining permanent accounts, those marathon runners we didn't zero out, and classifying them, the picture becomes crystal clear. We list our current and non-current assets, giving us 47,000 rupees. We list current liabilities at 8,000, and finally, equity at 27,000. This format instantly reveals the total weight of what the business owns versus what it owes to outsiders versus what actually belongs to the owners. But notice how interconnected this entire funnel really is. The income statement is your performance over time, the balance sheet is your snapshot in time. But here's the real magic trick of accounting. That 17,000 rupee net profit we just celebrated, it flows directly into the retained earnings on this balance sheet. That is exactly why the equation balances. The profit from your motion picture becomes a permanent fixture in your photograph. So, now that you understand how raw, chaotic ledger transactions systematically evolve into a crystal clear picture of financial health, it fundamentally changes how you look at business operations. Every single debit and credit has a final destination. Armed with this structure, it's time to ask yourself, when you look at your own financial funnel, what story do your numbers tell? Are they telling a story of efficiency and growth, or is there a chapter in there that desperately needs rewriting? Thanks for joining me on this explainer today, and keep asking great questions.